Hey, good afternoon. How are you? Welcome back to Lunch of the Market. So we have 2 days left until options expiration, and there is basically a street fight between the bulls and the bears right now. The banks are the unloved sector for today, and many of the smash stocks from yesterday, like Rare Earths, Vico Instruments, Highsoft, Deckers, they're actually all up 3% today. Okay, our 2450 or so level in HSFT was a great technical level. It hit there, and it looks like it bounced about a buck. Yeah, it's up right about $1 right now. So not bad, not bad. If you are a fast trader, if your time frame is small, go ahead and take off that HSFT. We are still going to look for about the $30 level, but again, that's going to take much more time, certainly than one day, and probably longer than a couple weeks. So if you're quick and you got in there at that 24-ish level from yesterday when the stock was obliterated, take HSFT off today, up a buck. NetFlix continues to wow and amaze participants. The stock was as high as 181 today before trading back down. That 178 level, that is your line in the sand. The stock right now is trading at 177.67, so it's within, close enough for government work. We've got about $2.77 of cushion going into options expiration, which is on Friday, and we've got 2 days and about an hour and a half left until that magic 4 o'clock p.m. Eastern Standard Time on Friday. Okay, if you want to be part of the longer term story of NetFlix, consider a call spread risk reversal 155, 170, 200. Okay, what is that in English? What that means is a long call spread. We're going to go by the January 2012 170, 200 call spread. So 170 is about $7 lower than where the stock's trading at right now. So some of the work has already been done for you. The spread's already in the money by $7. $200, it's not quite the all-time high of 209 that it hit, but it's realistic to think that if the company continues to grow at a better than 20% growth rate, that the stock could go back there. And what's a price that we would buy the stock if it got to, but seems a little unrealistic? That's the 155. Okay, so you get long a 170, that's where you're long. Sell the 200 call against it, that is a long call spread. And then on the bottom side, to finance that, we're going to sell the 155 put. Okay, so you're naked down here at 155. If the stock declines another $22, right, it was 209. So at 155, you're talking about $54 lower than the stock traded at its all-time high. Okay, so that's the structure that we like. Now, here's the kicker. If you hit the button to put that trade on, they're going to pay you $1,465 per spread. And the spread is $30 wide that you're long. So you're talking about max profit is the $30 between there. And of course, it's an option, so you have to multiply by 100, which means $3,000 max profit on the spread, right? Plus, for the whole structure, you're going to get paid $1,465 just to put it on. Now, remember, manage the trade. If the stock plummets, okay, you can't stay short that 155 if the story changes. You're going to have to go out and buy the 150 put below it to protect your loss and turn your loss from $15,500 exposure into just $500. Okay, it might hurt a little to go out and buy that put if the stock gets down there, but you have to do it. Discipline says you keep your losses short. Okay, what if the stock goes down there? I want you to take off the top of that call spread, so you'll turn into just a basic risk reversal. Okay, long call, short put. You shouldn't have to worry about that put for quite, like I said, $22 is where you get in trouble. The stock would have to decline another $22 after the decline it's already had of about $30. Okay, $32. So that's how you manage the trade. If the stock shoots up huge, right, and you got that call spread on there, please buy back that short put. Okay, take it off the table. Then that eliminates all of your downside risk, and then you can decide whether or not you've made enough profit on that long call to sell it at a gain. Okay, so that's how you manage the trade. That's the trade setup for the call spread risk reversal. Since we're in the mood of call spread risk reversals, let's do one more. Deckers, right? Jim Cramer, part of the FADSCAN, he's been on it. Deckers is a stock that we like the 70, 80, 90. Okay, so how's that work? Let's get out our little finger diagrams. You're long the 80-90 call spread. This is going to be July of 2011. That's the furthest you can go out in Deckers. July 2011 80-90 call spread. sell the 70 put against it. The stock's trading at, right now, $82.33. Okay, so there's actually already intrinsic value of $2.33 in this spread. Okay, you're going to sell that 70 put, which is $10 below where the stock trades at right now. July isn't that far off. It's about 7 months. Okay, and for this, you're going to take in $1.55. Of course, it's an option, so multiply by 100. You'll make $155 just for pushing the execute button on this trade structure. Instantly profitable. Max gain, of course, is the $10 spread times 100 equals $1,000 plus the $155 that you took in for a grand total of $1,155 if the stock is above 90 at expiration. Okay, 90 is your top where you're short, 80 is where you're long, and then 70 is where you're short again. Okay, once again, same thing. If this stock breaks 70, you got to go put a downside put on there, and of course, buy back your call on the top side that you're short. Okay, then it'll look like this. You'll be short a put spread and long a call on the other end of it. Okay, it's just in reverse. Okay, so that's how to manage the call spread risk reversal. That's 2 setups. Again, the January 2012 NetFlix 155, 170, 200 call spread risk reversal, and the July 2011 Deckers 70, 80, 90 call spread risk reversal. Okay, hope these 2 ideas will help. We actually really like the NetFlix call spread risk reversal, and we will probably have that trade on by the end of the day. Deckers, we actually already have an in the money call spread risk reversal on right now in Deckers that expires in December, so we probably won't lay that back out until we see how this Friday's options expiration goes. But we do like the longer term story of Deckers, and you can put the trade on for an instant win. We like those. So again, even if something goes wrong in that trade and you don't get to max profitability, you don't have a concern until the stock breaks 70, which is $12 from here. Okay, so big move to get down there to get in trouble. Same thing on the NetFlix. We like both those trades. We'll see what happens. There's 2 days left until options, 2 days and an hour and a half until options expiration. We're going to stay short those 175, 170 put spreads in NetFlix and keep our fingers crossed. And if not, we'll ultimately admit defeat on Friday and roll those down and out. But we'd rather not. So we'll see. Here's keeping our fingers crossed. Thanks for tuning in again today. Have a great day, and we'll see you tomorrow.